Every year, millions of people go looking for the investment that will change their life. The next hot stock, the next cryptocurrency, the next company everyone's suddenly talking about. Deep down, most of us believe wealth comes from finding something extraordinary. So we chase one trend after another, always hoping this could be the one. Here's what almost nobody expects. The single investment that has quietly created more millionaires than nearly anything else in modern history isn't a secret. It isn't new. It doesn't trend. No dramatic headlines, no overnight windfalls. Just decades of patient, unglamorous growth. Warren Buffett, one of the richest people who has ever lived, has spent over 60 years recommending it publicly. Jack Bogle built an entire company, Vanguard, around it. And still, most people walk right past it, chasing something flashier. So why do the world's wealthiest investors keep choosing what everyone else calls boring? What do they understand that the rest of us are missing? By the end of this video, you'll never look at investing the same way again. Think about the stories that make headlines. Nobody writes about the accountant who quietly invested every month for 30 years. Everyone writes about the 24-year-old who turned a few $1,000s into a fortune overnight. Excitement sells, patience doesn't. That's not a flaw in the media, it's a flaw in how our brains are wired. In 1999, at the peak of the dot-com bubble, a company called Pets.com spent millions on Super Bowl advertising, went public, and collapsed within 2 years. One of hundreds of internet stocks investors piled into on pure excitement, with almost no profit to justify the price. The Nasdaq lost nearly 80% of its value in the crash that followed. 9 years later, it happened again. In the run-up to the 2008 financial crisis, ordinary people took out mortgages they couldn't afford, chasing a housing market that seemed only capable of going up. When it collapsed, it dragged the global economy down with it. Different decade, different asset, same pattern. A rush toward whatever feels exciting, and a collective refusal to believe it could end. Meanwhile, through both of those crashes, one strategy kept quietly working in the background. Buying small pieces of thousands of businesses at once, and simply holding on. Which raises the real question. What exactly is that strategy? And why does it survive what everything else doesn't? It's not a secret hedge fund. It's not a strategy reserved for billionaires. It's something almost anyone can buy in a few clicks. An index fund tracking the S&P 500. Picture what that actually means. 500 of America's largest companies, Apple, Microsoft, Amazon, and hundreds more, bundled into a single investment. Buy one share, and you own a sliver of all of them at once. The smartphone in your pocket, the cloud servers running half the internet, the delivery trucks on your street. In 2007, Warren Buffett made a public bet. $1 million said that a simple S&P 500 index fund would outperform a hand-picked basket of expensive, actively managed hedge funds over the next 10 years. Wall Street's top fund managers took the bet. By 2017, the index fund had gained over 7% annually. The hedge funds barely broke 2%. Buffett won by a landslide. Not with a clever pick, with the market itself. That's the part most new investors miss. They spend their energy trying to find the one company that might become the next Amazon. Experienced investors skip the guessing game entirely and own a small piece of the next 1,000 companies instead. It's not thrilling. There's no headline moment, no single stock to brag about. Just steady ownership of businesses that keep building products, serving customers, and generating profit year after year, regardless of who's watching. So, if it's this simple, why doesn't everyone do it? Because owning it was never the hard part. Staying in it especially when it stops feeling exciting, is.
Successful investing has never been a contest to find the smartest opportunity. It's a test of nerve. Picture two investors living through 2008. The first watches the market in real time, sees the S&P 500 lose more than half its value, and sells everything to stop the bleeding. The second does nothing. No panic, no headlines checked every hour. They simply keep contributing to their index fund, month after month, straight through the wreckage. A decade later, the numbers tell the story. The market didn't just recover. By 2019, it had climbed to several times its crisis-era low. The investor who sold locked in the loss forever. The one who stayed captured the entire recovery without lifting a finger. This is the part that rarely gets said out loud in finance. Doing nothing is often the hardest skill to master, and the most profitable one. Fear, greed, and impatience don't just cost money in a crash. They cost money by convincing people to interrupt a process that was never designed to be judged in weeks. Markets have crashed before. The Great Depression, Black Monday in 1987, the dot-com collapse. Every single time, headlines declared the end of an era. Every single time, the businesses inside those markets kept adapting, kept selling, kept earning, and the index eventually climbed past its old highs. Boring investing doesn't win because it avoids the crash. It wins because it survives it. And survival, compounded over decades, beats prediction almost every time.
If there's one number that explains millionaire investors better than any strategy,
it's this: time. Picture an oak tree. In year one, it barely changes. In year two, still nothing worth photographing. But underground, its roots are spreading, quietly preparing for growth nobody can see yet. Years later, that same tree is impossible to ignore. Money compounds the same way. Early progress feels almost insultingly slow. Check the account after 6 months, and it barely looks worth the effort. Most people quit at exactly this point, convinced something faster must exist. But keep going and something shifts. The investment stops growing only from the money put in. It starts growing from the returns already earned. Money begins earning money on money it already made. Warren Buffett titled his own biography The Snowball because that's exactly what his fortune became. A snowball barely grows at the top of a hill, but every rotation adds more surface area, and every added layer picks up snow faster than the layer before it. By the bottom of the hill, it's unrecognizable from where it started. Buffett earned roughly 99% of his entire net worth after his 50th birthday, not because he suddenly got better at investing, because he'd given compounding 50 extra years to work. Time isn't just an ingredient in wealth building. For most millionaire investors, it's the one asset they protect above all others. Because unlike money, lost time can never be earned back. So, back to the question we opened with. Why do millionaires love boring investments? Not because they enjoy boredom, because they understand what that investment actually is. Ownership. Ownership in businesses that solve problems, employ millions of people, and keep generating value decades after the first dollar was invested. Buffett didn't build his fortune by finding the perfect stock. Bogle didn't build Vanguard by promising overnight returns. They built what they built by understanding a single, unglamorous truth. Markets crash. They recover. They grow. And the money that stays in the room longest wins, almost regardless of when it walked in. So the next time someone tells you about a once-in-a-lifetime investment, ask yourself one question. Are you chasing excitement, or are you building wealth? They are rarely the same thing. And history has already told us which one lasts. If you enjoyed this episode, subscribe to Budget&Grow for more cinematic breakdowns of the world's biggest financial ideas. And if this changed how you see investing, Send it to someone who's still out there searching for the next big thing. Thanks for watching. I'll see you in the next Budget Grow episode.